All right, enough detour. Let's get serious here. Fun stuff.
Yes, yes. Hello, everyone. Welcome to episode 32 of Making Sense, a Eurodollar University production. My name is Emil Kalinowski, and I am talking to the head of global research, the chief investment officer, not just of Alhambra Investments, but maybe all financial firms. Jeff Snider, good to talk to you.
Yeah, I think you're overselling me a bit, Emmanuel. What am I supposed to say? You've left me speechless already. We just started.
Oh, geez. Well, that's a new record. Good. Audience, write that down. Only 30 seconds in. So that's pretty good. What is the audience going to learn about in today's show? The audience is going to learn about how far behind the times the monetary technocrats and the authorities are when it comes to the monetary order. And that monetary order helps determine how your savings and your investments are doing. So it's good to know. All right, we're going to turn to an article that's been published today, the 23rd of October at Real Clear Markets. And the title is Central Banks Trying to Create Inflation is an Old Laugh Line. And I'm laughing because, Jeff, you don't pick the titles. So this is the first time you're hearing what the article is called. Isn't that right?
Yeah, we don't spend a whole lot of time on inflation in the article, but as you pointed out, it's mostly about the history behind where we got and what are authorities trying to do to try to catch up with what is really a half century of undiscovered monetary territory. And really, I think that's the point. It's not really undiscovered. It's only undiscovered in the official sense, in traditional definitions. By and large, there is a body of scholarship that has been sort of lost. I almost feel like we're kind of like monetary archaeologists going back into history and digging up all of these useful nuggets of wisdom that that showed up or that were created 4 or 5 decades ago. People who were back in the 1970s and even the early 80s who were more attuned to what was going on, and therefore, ironically, somebody in 1979, for example, probably knew more about 2020 than any official anyway, in 2020 could be.
And like any good movie of archaeologists, I guess I'm thinking of Indiana Jones here. We're going to start in the middle of the story and then work our way backwards and forwards to reveal the whole plot to the audience. And you do that by picking 3 months, May 2018, September 2019, and March 2020. And like a good movie, you start in the middle, September 2019, in that article. What happened in September 2019?
That was the infamous repo rumble, where repo rates jumped in the middle of September. What we call around here the September bottleneck that was particularly harsh. And it caused all sorts of problems because, not for one, the Federal Reserve at that time was trying to quiet fears that were growing about the economic circumstances in the U.S. and also all sorts of other things that were happening, including the lower level of bank reserves, where people were saying quantitative tightening, too many treasuries, all of these various theories that were being espoused. But they were what they all shared. The common thread through all of them was that it was obvious there was growing illiquidity in the U.S. dollar system throughout 2019 that nobody could put their finger on. And then all of a sudden, September 2019. It was so obvious that something was wrong, something bad was taking place, or something abnormal, that even the Fed had to get pushed back into the QE business again, and repo operations, all sorts of other things. So something was going on.
Let me stop you right there, because if Jay Powell was here, and maybe he is, maybe I've got him tied and he can't talk, but let's say he is here, what he would be saying? He would say it wasn't QE, Jeff. And they made a pointed, explicit publicity campaign or push to reinforce that message. Jeff, why was it not QE, both for technical and qualitative reasons? Why?
Well, first of all, Jay didn't want people to think it was QE because he didn't want people to think the U.S. economy needed a QE. He wanted everybody to remain calm. They did a couple rate cuts. That was gonna balance the situation, the economic situation, get everything back on track. And he worried that if people thought the Fed was being forced into QE against its will, that would make people think wait a minute, something's really wrong here, and then they would act. Remember, monetary policy is all about sentiment, and he didn't want to create a negative sentiment around what was supposed to be a technical issue. As a technical issue, the Federal Reserve and Jay Powell said, look, this, whatever we got to do, we got to raise the level of bank reserves. Why do we need to raise the level of bank reserves? Because that's what we do. That's all we do, in fact. And so every problem that rises, the Federal Reserve has to raise the level of bank reserves. That's what they do. And in order to do that, they have to buy assets, which they had conditioned the public before then to believe that buying assets of any kind was quantitative easing. So in order to make this and distinguish this not QE, they decided, well, we're only going to buy Treasury bills. We're not going to buy bonds. We're not going to buy notes. We're not going to buy longer-term Treasury securities, just the short-term stuff. And really, there's no reason for them to have done that except public relations to try to distinguish this not QE from QEs. Except that in buying Treasury bills, it was exactly the worst thing they could have done. You couldn't have picked a worst possible strategy at that particular moment in time.
Why?
Well, because Treasury bills are the primo collateral, the prime of the prime, the pristine of the pristine. Treasury bills are what the repo market really runs on. And that's what prompted the Federal Reserve response was a breakdown in repo. But everybody always focuses on the cash side. They never look at the collateral side because, well, nobody's ever told them to look at the collateral. Nobody knows that you need to look at the collateral side. A repo transaction sounds very simple. Someone has cash, someone has collateral. The collateral owner borrows the cash, end of story, right? It's really that simple. But it's not. In fact, there's more stuff going on the collateral side, which should have become obvious and apparent and open into the daylight of mainstream thought and convention all the way back in September and October 2008, but it never happened. It was buried under the idea that the first global financial crisis was actually something about subprime mortgages. It had nothing to do with repo or repo collateral, when in fact it had everything to do with repo and repo collateral. So,
the repo market, I guess they'll accept any sort of security, but they really like the most liquid one, which is the short-term Treasury bills and on-the-run Treasuries, which are the most recently issued vintage version of a recent Treasury auction. Jeff, that's one of the questions that we received from the audience is why isn't a Treasury bill, note, bond, whenever it was issued, aren't they all as liquid, as valuable? Why is there this difference on the run, off the run?
Well, remember, there's literally hundreds of Treasury securities, and there is no one 10-year bond. There's specific QSIPs that trade. There's specific issues that trade. Some trade, some don't. And so some issues are liquid, some issues just aren't. And when we're talking about the Treasury market and the way the repo market and what it really factors, if you're lending cash to somebody and they're giving you collateral, you have to have a dependable market that tomorrow morning, if you're going to default on the cash loan, I got to liquidate your security. And therefore, I have to be absolutely certain that tomorrow morning, if you default, I can liquidate your security at the price I need to liquidate at. And so if there are parts of the Treasury market that don't trade, if they're stale QSIPs, off-the-run stuff that don't regularly trade, I don't really know if I can sell it at the price I want to sell it at. The market is only, the real market where there's liquidity and actual trading activity, what hits the tape, for example, is mostly the on-the-run stuff. And so when push comes to shove, you're a repo counterparty, you're holding collateral that you're worried about having to sell, you're going to prioritize the stuff that has a liquid market that you can analyze and look at and say, tomorrow morning, I'm almost absolutely positively certain I'll be able to sell it if I need to. That's why the on-the-run stuff is the pristine of pristine, and Treasury bills are on the run.
Exactly. I interrupted you earlier. Treasury bills, the short-term stuff, the less than 1 year stuff, is the most liquid. And since September of 2019, the Fed was pulling them out of the market. And that's to your point of could they have picked a more damaging intervention to the market? No, but Jeff, I thought
to me, it's worth. Look, it was the Fed gave out bank reserves to the 24 primary dealers, and in return took away Treasury bill collateral that was used in the repo market. So when we got to March 2020, what was the big problem in March 2020? The lack of Treasury bills. And you could see it every day that the stock market had its worst day. The morning started exactly the same way. In Asian trading, usually, the overnight hours when some of these repo trades started to unwind from the previous day, you'd see Treasury bill yields drop to minus 20 base, 25. I remember one time the 4 week was at minus 28, which showed you that there was overwhelming demand for Treasury bills when the repo trades were being unwound from the previous day, which meant that if you were lucky enough to secure Treasury bills, great, you could go on that day. If you weren't, that meant fire sales. It meant, swapping into gold. It meant all sorts of things that would follow onto it. So on the days where the Treasury bill yields were ridiculously negative, those were the days in the morning you'd see the stock market sell off by 5-10% at the open, whatever it was in some of those days. So there's a connection between the repo market and liquidity through all the financial markets all the way around the world. It's a central point for the financial system globally. And here we had the Fed from October 2019 up until March 2020, removing the best collateral from the central pivot of the financial system and giving out instead these useless, inert, waste of time bank reserves.
Jeff, I thought the Fed had already learned the don't vacuum up short-term Treasury securities lesson in 2011. Wasn't that what Operation Twist was all about? And so what happened? Why did they forget
I think that was one of the, I don't think the necessary, Operation Twist was about, hey, we need to less Treasury bills and we'll buy more Treasury bonds. So we'll let the bills go back in the market. We'll buy more Treasury bonds because there are all sorts of problems in collateral. But did they learn the lesson as you put it? I don't think they actually learned the lesson. I think for them it was more of a, hey, this is a technical issue that we need to look at, and we'll solve it. We'll solve the bigger problem by more QE, which is sentimental effects of getting people to be happy about we're doing something big, no matter what it was. And so Operation Twist was kind of like a quirk to the overall strategy, which was still QE. And so you get to the late 2019, and the Fed's thinking, I got to do the strategy. I got to do the sentimental effect. I got to do big buying because I got to raise the level of bank reserves enough so that these dealers no longer complain about these technical factors in the repo market. And so they did the overall buying, but what was their priorities in that buying? They had to make it a not QE, which meant they focused exclusively on bills at the worst possible time.
So the first half of your article is about setting the stage, and you discuss 3 months. We just talked about September and March, but our first clue, and perhaps what we could identify as the kickoff date of the fourth Eurodollar crisis, was May 29th, 2018. Can you tell the audience a little bit about that day?
Yeah, something about the Italian financial minister being fired or sacked or something like that. No, that's what the media speculated on. But what happened that day was you had a buying panic in Treasury and German bond markets, and I think a little bit in JGBs too. So the top tier of the global sovereign bonds were hugely bid. Remember, May 2018, this was inflation, economic growth, all the things that were supposed to lead to interest rates going significantly higher. And we had this day where interest rates fell sharply. The 10-year Treasury note, I forget how much it was, but it was a significant reduction in yields all at once. And oh, by the way, before that, leading up to that, we had this dollar spike. So you had the combination of factors that were looking at, these things, there's some really bad stuff going on in the global dollar system. Then it erupted in this May 29th thing, which was because it was buying panic in Treasuries, you're immediately, your senses say something's going on in the collateral side of repo. And there was all sorts of stuff before then too that said something's going on, there's a liquidity. But May 29th was when it became sort of real. It became something from out of the shadows into something, into something that you could actually put your finger on.
So in a word, what links all 3 months is collateral. In 3 words, what links all 3 is securities financing transactions. And if I would add a few more words, it would be, quote, in particular, a lack of transparency in the use of security financing transactions has prevented regulators and supervisors as well as investors from correctly assessing and monitoring the respective bank-like risks and level of interconnectedness in the financial system. Jeff, tell the audience where that quote comes from.
It comes from the European Union in November of 2015. And that was authorizing a data collection process, which is still finally getting going this year. But essentially, it's a culmination of many years in the aftermath of the great financial crisis, where regulators, authorities, politicians, whatever official part of the sector you want to talk about, what they finally realized is that, there's stuff going on here that we really don't have a good handle on. It has become very obvious through repeated action. This stuff is important, and maybe we should pay attention to it. And as you said, SFT, Securities Financing Transactions. What is that? It's exactly what we just said, and we're talking about the last part of 2019 and into 2020. It's collateral, securities lending, all the stuff that's interesting and strange and weird and complex about the collateral side is that banks engage. It's not a repo transaction is not simply you have cash, I have collateral, we get together. It's oftentimes I have questionable collateral, or maybe I don't have collateral at all, and so I go to a bank and I borrow it and I transform it. I do repledge it. The bank repledges it. There's maybe even rehypothecation, as contentious as that issue is. There's all sorts of stuff going on the collateral side that nobody pays attention to, even though, again, back in 2008, that was the most prominent feature of the first global financial crisis. And the quote that you just read, Emil, says is that, look, we realize it. Something about SFT is very important. It's interconnectedness. There's, lack of ability to analyze all of these factors. The stuff that we just talked about in 2019 and 2020, the European Union was saying, we're going to come up with a regulation that says we need to study this problem.
And so it's, on the one hand, it sounds like it's good news. Finally, someone is saying, this is very important. We need to study it. And so that's good. That's great. I'm happy. I'm thrilled. I think this is what we've wanted to hear. But you make the point in the article, and I think this is the larger point of our discussion here, is that this is taking a real long time. That quote I read was from 2015 from the regulation, but it was first introduced or asked for public comment in 2014. And then you also introduced a pair of academic researchers who were doing research in this area. And it was the paper that you referenced is called Innovation in the International Financial Markets. And this was written a long, long, long time ago.
Yeah, and I think that's, November 2015, only in Europe. The European Union says, let's look at SFTs. When the first real major breakdown in them, you can go back to March 2008, but really, September and October of 2008. There's a 7-year gap there. 7 years. And finally, the European regulators are saying, hey, maybe we should get serious about this. I mean, that's the lack of urgency is what really stands out here, is that why weren't they doing this in November of 2008? Where was the SFT regulations back then? And so you're already starting to wonder, okay, what's really going on here? Are they really serious about it? I mean, yeah, it's a serious issue, but are they taking it serious enough where it's a front burner thing? And it's obviously not, because, again, as we just went through 2018, 2019, and 2020, here we have the Federal Reserve paying no attention to SFTs, in fact, making the SFT side of things that much more harder and difficult, so that when we got to March 2020, it was the worst possible case. So yes, the Europeans in 2015, and before then, they had been working toward this. I think that's the funny thing too, is November 2015, they start, they put the regulation in place. Well, when did they start signing up and collecting data? This year. April of 2020, they finally signed up for what are called TRs, which are trade repositories, which are in the securities lending business. And so they're only in 2020 beginning to collect data in a pilot program on the SFT side of things. And oh, by the way, the larger point too, and what we're going to talk about next is really about what's cleared on trade repositories. The amount of securities lending and securities financing transactions that goes on centrally cleared agencies like that or exchanges is very small. most of what takes place in the repo market as well as the larger Eurodollar market is simply bilateral transactions or sometimes trilateral transactions between banks that never appear any statement, any tape, anything. So even now, the European, after 13 years, after a dozen years since the first, the big breakdown in September and October 2008, only the Europeans are looking at SFTs in only a minimal way. So a dozen years later, is it really? I mean, yes, it's kind of good that they're looking at it and they realize it's important, but are they really doing anything significant towards identifying and uncovering all the real bad, potentially negative stuff that goes on the SFT side? And as you were saying, what we're really talking about here is it's not really just a dozen years. This is a 50, 60, 70-year-old story.
And you bring up an example of a couple of researchers who wrote a very interesting paper in 1981 saying, look at this, look what is happening, look at this proliferation of products. The
proliferation of products, I use that specific term, obviously, people who might be familiar, but for those who aren't, in June of 2000, Alan Greenspan in an FOMC meeting discussing the Humphrey Hawkins, the Full Employment Act of 1978 requirement to produce money supply targets, they argued that they shouldn't have to do it anymore because they couldn't define money. Therefore, they couldn't define it, they couldn't measure it. And what he said was, one of the reasons, obviously, is that the proliferation of products has been so extraordinary that the true underlying mix of money in our money and near money data is continuously changing. So a decision to base policy on measures of money presupposes that we can locate money. And that has become an increasingly dubious proposition. And that was June of 2000. But, what Greenspan was talking about was not something that took place in 1999 or 1998. This proliferation of products actually happened starting in the 50s. And it really was the 1960s and the 1970s, as this paper you pointed out by, I think his name was Günter Dufey and Ian Giddy, they published in 1981. It was a really good paper that went through a lot of different financial innovation. And it wasn't just the stuff that stuck. They went through, a lot of things that failed. They said, look, banks experimented with this and they experimented with that. And here's the stuff that has stuck around by 1981. So Greenspan's proliferation of products in June of 2000 that had erased the Fed's ability to define and base money supply or monetary policy on money took place back in the 60s and 70s, which is absolutely mind-boggling that the central banker would say something like that, and how that actually related to how history developed over that period of time. Of course, eventually leading to 2007, 2008, and its aftermath.
Jeff, this whole article came to us from an audience member. He sent along a message that the European Securities Market Authority was gathering this data. And then you dove into it and explained that, it looks good on the surface, but really it's 7 years after they first kicked off the initial trial, or they brought it up, and then 7 years after actually the crisis, and 30, 40, 50, 60 years after the horse has been let out of the barn. So audience,
what I want to say is, I think that's absolutely fantastic that we have an audience that pays attention enough, that knows enough to flag these kinds of things, and absolutely encourage them to send these kinds of things to us, because they're worth discussing. They're worth talking about. Even if, we don't have to get into necessarily all the details, although we could, but really, just in the big picture sense, our major problem here is that we have monetary authorities who have no authority on money because they don't even know what the hell it is. They don't know what goes on in the monetary system. And when you say something like that, people who aren't familiar with this stuff immediately think you're crazy. Like, well, how can Jay Powell not know what goes on in the repo market? Well, it should be obvious to you by now that he doesn't. I mean, stripping Treasury bills from the repo market in the aftermath of September 2019 was demonstrably, not just, I'm not just making, this is not my opinion. It's demonstrably the worst thing the guy could have done. And the only reason he would have done that is because, unlike in Europe where they're paying attention to SFTs, the Federal Reserve pays no attention to this stuff. They don't care. They believe in their sentimental effects of raising the level of bank reserves rather than any kind of monetary competency, which is the big problem here, because we have a monetary breakdown. You can't fix it with a puppet show and a fairy tale. You actually need some competence. And at least, if you want to look at it positively, at least the Europeans are thinking along those lines, but yet not really doing it with a sense of urgency that seems to be required.